Do you think this is a dip worth buying, or should I hold off and be a little more cautious?
Well, Tyler, there hasn't really been a dip in the U.S. We're only about 2.5% off the highs. But if you look at China, with the stocks being down 8% overnight after having been closed for an extended period, I'd say it is too early to buy that dip. We want to see the peaking in the cases being identified before you could consider there being the conditions for a bottoming in this. We're just starting to understand how broad the economic impact of this would be. So I'd say it is too early to buy China on the dip that it's experienced.
Mike, you sort of have the same view. You say don't look to buy this correction, if correction we can call it at this point. But over the next 6 months, you see stock prices moving higher. So the question is, why not buy now if they're going to be higher in 6 months from now?
Well, first of all, I think Jim kind of encapsulated pretty well. I do think what you are going to see, until we see a peaking of the infectious rate, and until we get a sense of just how deep the outbreak is, there's still some things we just don't know about how this is playing out. So for our view is we're going to have more volatility ahead. But the underlying views in terms of what we think in terms of the rebound in global manufacturing, which is beginning right now, which we certainly saw today in the U.S. ISM data, we think those suggest that over the course of the next 6 months that this will be episodic. We expect it to be regionalized, largely within China and then throughout parts of the emerging markets, but that we don't see this as presenting the environment where it's going to lead to a material global growth slowdown for the balance of the year. So short-term volatility marked by some economic dislocations regionally. We think for the balance of the year, it pays to remain invested, but be careful not to get too excited. If the market gets these short-term periods of volatility, don't get caught trying to chase them down.
Are you, Mike, overweight now in emerging market equities? And if so, why?
So we have a balance in terms of our portfolio. We do have exposure in the U.S. We also have exposure in emerging markets. One of the reasons that we still have exposure in emerging markets is what I mentioned before. We see this global manufacturing slowdown is running its course. We do expect to see it reaccelerate, especially in the second half of this year. It could be stalled about a quarter, especially in China, because of the fallout from the coronavirus. But our view here is that the conditions for the emerging markets with regard to likelihood of a softer dollar over the balance of the year, that rebound in global manufacturing, suggests to us that emerging markets, where there is more value, will have a better opportunity for investors in the second half.
Mike, last hour we heard from a guest who said he'd buy, for example, the stock of Luckin Coffee, that there are some opportunities created by this dislocation, but you have to take a pretty long-term view. Would you nibble or sip at anything here?
So when you say, would I nibble here, look, I think we have to be really careful. We're still early days here. We just had the Chinese market just opened. So I think what we have to focus on here is, okay, how is this infectious rate playing out? And by the way, it's not just about how it plays out within China. It's the infectious rate as it begins outside of China. How prevalent is it? Is it going to be well contained? I think what's happened so far is the Chinese officials did a very good job of trying to localize it and make sure that they had quarantines so it didn't spread throughout China. The reaction function is much different than it was in SARS. But let's also remember that the world is a different world than it was during SARS. When we're globally integrated, China plays a larger role in the economy, and certainly global travel plays a bigger role now. So we have to be careful not to just get caught into a very, very short-term dip and see that just as a short-term opportunity.
Yeah, Jim, same question to you. You know, are there ways that you can, say, hey, this storm too will pass, take a bullish outlook, for example, on the Chinese consumer, or is there a reason why some have suggested that this could sort of reveal deeper cracks within China, challenges to the leadership, to stability there, or what have you?
I would take more of the latter case, Kelly. We are underweight emerging market stocks. This was not what they needed to have happen right now at a time when there is focus on deleveraging in China. There still is a risk around the trade front. There are reports out that China is talking about asking for some abeyance and having to meet the commitments on the Phase 1 deal. So we very much favor U.S. assets over emerging markets at this point, like high-yield bonds and like interest rate-sensitive equities like global real estate and global listed infrastructure.